As I sit down, to my right, we have John Rogers, who is CFO of Sainsbury's, but also, importantly, for the Accounting for Sustainability Network. He's also one of the co-chairs of the CFO programme that we have. We also have Roger Seabrook, who is Head of Investor Relations at Unilever, and again has been very closely involved in the investor programme that's been led by the CFO Network. And finally, to my right, we have David Blood, who's known to many in the audience, not only for setting up Generation about 10 years ago with Al Gore, but prior to that was CEO of Goldman Sachs Asset Management, so has spent his career as an investor. And it's this whole area of investor engagement that has cropped up at various points in the conversation today that we want to explore. We also want to make this as an interactive a session as possible. So I'd encourage you right now to start thinking about the questions that you'd like to ask our panellists and why they think investor engagement is important. But perhaps we could start off, we've done this before, during the afternoon, with a couple of questions. And you each have 2 cards with you. A green card for yes and a red card for no. And the question I want to ask to begin with is, do investors care about sustainability? So yes, hold up your green card, no, your red card. So that's a very interesting mix. One of the things we want to explore is the gap, because we've heard already that some feel that investors aren't asking the right sort of questions, and others feel that CFOs aren't presenting the right sort of information. So I'd like to ask our panellists for an initial reaction to that roughly 50-50 sea of green and red cards, as to what their experience is of investor engagement on sustainability. So John, if I could ask you to start.
Yes, I guess having done investor meetings now for over 5 years, I think I probably can count on the fingers of one hand the number of questions that I've been asked directly in relation to sustainability. That said, we know that sustainability for our business, for Sainsbury's, is absolutely at the heart of our business. If we don't embrace sustainable business models, we don't have a business in 10, 15 years' time. So take things like, for example, Ethiopian coffee. With global warming in 15 years' time, if we do nothing, we will not be able to source coffee from Ethiopia. So we have to embrace sustainable business plans as part of our overall strategy. I guess, therefore, the onus has got to be on CFOs. I think the responsibility has to sit with CFOs to make sure that we are getting that message across to investors, that we are highlighting the importance of sustainability within our business plans, that we see it as being very much integrated, woven into the way we do business. So I think it's probably harsh to criticise investors too much if businesses like us don't get the message across in a very strong way.
Roger.
I too have been doing investor meetings for about 5 years for Unilever, and it's absolutely true that in the beginning of that period it was very rare that we got any direct questions about sustainability. But of course, for our business, just as for John, it's absolutely at the heart of us having a business long into the future. Whether it be sourcing our raw materials or whether it be the consumers that we serve. And what has been interesting and what is encouraging about the vote that we just saw in the room is that over the time I've been doing the job, I have seen a growth in the number of questions around the subject of sustainability. It doesn't often come in a direct form, but it's much more around the real business impacts of the things we're doing, and particularly long-term investors trying to get underneath not just the word, but what is it that the company's actually doing differently to respond to the environment and to respond to those challenges. So I think whilst it is still rare, and I'll be honest about that, I do see a change over time to have more questions and more searching discussions about sustainability.
And David, finally, your perspective. I mean, it's very much a part of your whole investment strategy, so how do you see this?
Well, we clearly care about it, but I think it's important to differentiate around the different types of investors. There are long-term investors who may or may not be focused on specifically sustainability, but indeed they are. They're interested in the long-term success of the business. And then there are traders. And the traders tend to not care at all. And oftentimes, the sell side will represent the traders. They will be the ones that will be most frequently at investor meetings and will oftentimes lead the discussion on conference calls. And I think that can be confusing oftentimes to the companies because they get a sense that the critical issue is next quarter's earnings, et cetera, et cetera. I would say categorically, if it matters to the long-term success of the business, sustainability, if it's integrated into your business strategy, you should discuss it, you should tell us why it matters, and you should tell us how you're measuring it so that we can measure or evaluate your success.
So I'd like to open up to the floor, perhaps from somebody who raised a red card, if you're willing to give the perspective that you have felt or seen, observed from your engagement with investors. Is there anybody who'd like to respond to that? And if not, what about somebody who raised a green card? Is this the way things are moving? So yes, please. Have we got a microphone?
Is it possible that investors all care about sustainability, but they don't know that they care, and they need a translation service of some sort to be able to understand the fundamental issues at hand without it becoming polarizing or ideological? So could it be they care, they just don't know that they care?
So a translation service. John, would you like to start with that? That feels like a CFO type question.
I think that's spot on. I mean, it's fairly obvious from our perspective why we care about sustainability, why it's important to our business, for some of the reasons that I've already cited. But I think you're absolutely right. The onus, I think, has to be on companies to get that message across to investors. And so when we talk about our strategy, when, often in these meetings, it is a bit of a sort of one-way flow, questions and then management responding. But we need to make sure that in our response, we can weave and direct those questions to introducing components of sustainability into our answers and why it's important. We need to be able to get that message across. I think they do. I mean, it's fairly obvious from my perspective that if we didn't embrace sustainability, whether it's in our supply chain or in our energy costs, then we are not going to have a business in 10, 15 years' time that's as good as it is today. And I think that's a matter that investors care very deeply about.
Roger, I know you've been involved very closely in the writing of this new document that were put up on the screen earlier. That's full of practical examples of what companies are already doing in this space. Would you like to talk through some of those? Perhaps what Unilever's doing?
Yes, and if I might kind of just build a little bit on what John said. As I was rereading some of the interview notes that we had with many investors and sell-side and brokers as part of the project, there was one comment which really sort of struck me last night, and it was that one person said to us, so few companies make the case clearly for why this is commercially important. And that was really the foundation for the work we did, because it's absolutely true that it takes two, and we as the people working for the CFO network could have spent our time thinking about what investors should do differently. But we based our work on the fact that actually companies need to start. It's us that need to really make the first step forward. And I think it goes without saying, and many speakers have said it earlier today, that there really is no point starting with the external communication. You have to start by actually doing things differently inside the company. And I think that's where the translation then comes through. Because if you really are running your business differently, if you really are looking at different metrics and different ways at looking at value creation, then of course you have a platform from which to have the conversation. Now there's still big challenges, and there's huge challenges, mainly because the costs are nearly always identifiable and nearly always today. And many of the benefits we're talking about here are sometimes very hard to value and further in the future. But for me, that's where those conversations have started to become more useful and more practical once we've started to get into those facts and to translate the sustainability word, which in some cases has become a blocker, into those practical actions. And that's where we've seen sort of a platform for much more productive discussions.
Thank you. There's another question in the front row over here.
Thank you. Christy Wood, an IRC board member. So a question for David. What can we do then if your case that we need more long-term investors and not traders is part of the answer? What do we do to create that? And then for the two companies, what have you done with your own pension plans to be sure that it's being managed in a long-term way and not by traders?
Great questions, David. Thank you.
Well, Christy, I think the good news is we have some natural long-term investors in the financial systems, ranging from the pension funds to the foundations, the endowments, the sovereign wealth funds. Many family offices are also inherently long-term. And in fact, one of the things that has frustrated us over these last 10 years is that the long-term investors often confuse themselves and think of themselves as traders. They begin very focused on next quarter's performance. Sometimes the asset owners become very focused on asking asset managers about next quarter's performance or evaluating us on a quarterly performance basis. We need to move away from all of that. Long-term investors have a structural advantage to deploy capital in a long-term way that will allow companies to grow and allow us actually to have a much more sustainable economy.
Just in relation to pension schemes, I mean, I think it's fair to say we're on the start of that journey with our own pension scheme as to how they embrace sustainability and where they make their investments. I mean, clearly our colleagues, 160,000 colleagues, care very deeply about sustainability. It's at the heart of our business, it's at the heart of our values, and so I think actually initial conversations with our pension scheme over the last couple of months have been very, very positive, and it looks like they will start to introduce sort of charters of investment in relation to how they themselves are willing to invest our colleagues' funds in sustainable businesses.
We have another question over there at the back. Steve. Thank you.
There are too many Steves.
Apologies.
Thank you very much for the opportunity to ask a question. It's Steve Wager from Aviva Investors. I really liked what Kirsty Wood just asked about how do we grapple with the financial services sector? How do we change the incentives? I think if you look at the incentives of brokers, of stock exchanges, the business models, and also the pay. If you look at the incentives of investment consultants as well, you'll find that the doing, if you like, the short-term thing, promoting trading, improves profitability for those institutions. Stock exchanges themselves used to be quasi-regulators. 50 years ago, they were not-for-profit. They're now total shareholder return is embedded in their executive remuneration. Investment consultants advise on tens of trillions, but they too have an incentive to move people around too much. They get paid 10 times the retainer whenever they look for a new fund manager for their clients than just the standard fee. Brokers, of course, they benefit from a percentage of the transaction. So we're here talking about finance and we're here talking about accounting. I think we also need to think about incentives and really consider how the incentives of the system is undermining sustainability. Accounting is incredibly important for that. I think accounting could also help change incentives because we could start to use the end data from the corporate disclosure to show clients where their money is being invested, what is the kind of sustainability profile of their portfolio. And at the moment, the data is improving, but it's still not particularly pervasive. Now, one of the sources of demand and how you would change incentives is for us as individuals and for us as institutions through our own corporate pension scheme, for example, to challenge that system, to challenge their incentives, to challenge what they disclose, and to ensure that they do embed sustainability into their, for example, recommendations of which fund manager to use, or which, what to disclose on the stock exchange, or how to what buy, sell, and hold recommendations to make. So I guess I would just like to give full credit to Unilever for what they're doing with the pension scheme, and encourage everybody else in the room who represents a company and has influence as a trustee on the pension scheme to put pressure on the market so that what we're talking about is actually demanded by the investors you're focusing on here.
So some fantastic points, Steve. Thank you. Again, we're trying to keep this very practical. So could the panelists give a very practical response to something that they can work on that chimes to this whole incentives question?
I mean, on the incentive point, I think you're talking about incentives there on the buy side, which I wholeheartedly would support. Actually, what's also interesting is incentives from a company perspective as well. So we heard DSM earlier on talk about how a significant proportion of management remuneration is dependent on deliverability of sustainability targets. And so I think the incentive argument, I think, works on both sides of the coin.
And from Unilever's point of view, we too have a lot to do. So by no means do we sort of stand saying we think we've got the answers to this. But it is absolutely true that the penny dropped at some point, that whilst we were talking about sustainability, we realised, sustainability in the financial markets, we realised that we had 80 pension funds in 40 countries with a total of $21 billion of assets under management. So we ourselves, in an indirect way, have investors, are investors. And what we've done has been very straightforward so far. We have started to screen those investments through the ESG type, the environmental, social, governance type factors. We have started to compare across pension funds to see where our money is invested and what we can learn across the pension funds. We've signed up for the UN principles, and we're starting to get into that very difficult area of how do you incentivize the management fees. And that is a harder area, and it's, as many of you will know, it's hard because of the trustees who also have a very independent role to play here. But we absolutely believe that the company has a role to play, and we should take a leading part of this, and that's what we're trying to do.
And David, do you have a comment on the whole incentive side, particularly the sell side that you influence, or indeed the way some of your clients, some of your pension funds are influencing that debate?
Well, we definitely agree that the incentive structures in the financial services industry are misaligned, and we would certainly support long-term oriented fees for fund management, whether it be 3 years or 5 years, to evaluate the success of mandates. And indeed, in fact, that's how we operate ourselves.
So we've got a lot of hands going up. We don't have a huge amount of time. So can I ask people to ask short questions? The microphone is over there. Thank you.
Just a few weeks ago, Mark Carney talked about the tragedy of horizons, which really goes back to the point I think David talked about earlier on today. And in fact, it was at an integrated reporting session at the World Bank annual meetings in Washington, which was initiated by His Royal Highness, I might add. But I just wonder, especially you, David, that do you think that the sort of global trend that's happening around regulators and governments around stewardship codes, so being in the UK but is now in Japan is one of the most recent, actually could also influence this whole engagement with investors?
I do, actually, very much so. I think in addition to incentives, engagement would be another critical issue that we need to resolve in the investment management industry. We too easily pretend like it's not part of our jobs, which I find shocking, actually. And it's something that we think that we ought to all be investing more time in.
Question in the front row, thank you. And please put your hands up so we can get the mics to you in between.
Sandra Guerra from the International Integrated Reporting Council and also Brazilian Corporate Governance Institute. My question is in regards to the transparency that was required by investors for so many years to have quarterly results, and how these quarterly results orient for short-term thinking. So this is an equation. What are your ideas in how to solve this?
Roger, would you like to take this one? Because I know Unilever has done some work in this area. Thank you.
So, quarterly reporting. I mean, during the period that Paul Polman has been our CEO, he's been very vocal about this subject, and very vocal about the fact that the 90-day reporting cycle can cause the wrong behaviours. So what we've practically done in that period is we have stopped doing full financial reporting for quarter 1 and quarter 3. We still have a statement to the market, we still talk about our performance, but we don't give the full financials until Q2 and the full year. And in general, I have to say that the reaction from investors to that has been positive. Of course, there are those who would prefer more frequent data, and they tend to be the shorter term, but for the long-term investors, they really prefer the longer cycle. I think a big question is now coming with the changes in regulation in Europe, where the requirement for a quarterly report at all is being changed, so that you don't even have to make an interim statement at all. And I think there's going to be far more debate about whether it's right to stop saying anything in the Q1 and Q3 ends. And the reason for that is I think the fear will be that if the company doesn't say something, that other information sources will fill the void. So I'm sure that will be a long discussion that will carry on, but certainly from our point of view, moving away from full financial reporting has been an important step.
I mean, as part of this, sorry, I was just going to say, as part of the process, we actually of looking at the whole issue about sustainability and talking to investors, we did speak to a whole bunch of fund managers from the UK, and when we raised this idea of dropping quarterly reporting, I was actually quite surprised that the response was very, very positive. Many fund managers don't see the need for quarterly reporting, see it as encouraging short-term behaviour and not long-term behaviour, and certainly from my side, I would absolutely welcome it.
I think someone towards the back has the mic. Thank you.
Richard Howard, European reporter. To John and to Roger, I sit in meetings often with businesses who say it's all the fault of investors, and then I go into meetings with investors, including Aviva, who we heard from earlier, who say it's the businesses that won't give us the information. Is it possible that just people should notice that each has changed and sort of wake up to that fact? And Roger, if on the UNPRI, there are 1,200 investors who are signed up to it. Now, I know there's a difference between signing and doing, but I think that commitment means more than nothing. Would you agree with that? And finally, David, I think you make a very interesting distinction between investors and traders, and high-frequency trading is obviously a problem, but the problem is that's the way traders make their money. How do you think we can alter incentives to try and really tackle that problem of high-frequency trading?
Brilliant. So 3 different questions within that. I think the companies, if you could...
Yeah, I think from our side, we'd be absolutely open at sharing data with investors on issues of sustainability. We do so already on a quarterly basis. We produce a quarterly CR report which updates the city on against a whole bunch of targets that we set ourselves over a 5-7 year time frame. I think for me, though, in a way, what I'd really like to see is not sort of reporting on issues of sustainability as an addendum or an add-on to what we do, but be able to really engage with investors and describe it as absolutely being integral to our strategy, so that they really understand why it is we do the things that we do and how it drives their shareholder value.
And I would agree with that. On the subject of UNPRI, I would agree that it is making a difference. I would perhaps challenge, though, that still too often it's different parts of the investors that I sit in front of who care about it. So still too often there will be portfolio managers who perhaps don't reflect that kind of background in their questions, whereas there will be other parts of the same institutions who care about it a lot.
And lastly, on high-frequency trading, as an investor, we're always going to be in favor of liquidity, but I think increasingly people realize that high-frequency trading is not provision of liquidity, and that we need to think about regulating that in certain respects. For example, maybe holding a security for 1 second before you trade or not.
I think someone's got a microphone. Yes, thank you.
Hello. Barry Gardner, the Shadow Minister for the Natural Environment. Can you, each of you, identify one aspect of the regulatory regime that could be changed that would actually affect investors' behaviour positively in the way that we're seeking?
Who'd like to go first on that? Changes to the regulatory regime.
I'll pass it on to one of my colleagues while I think of a response.
So let me have a go.
Thank you.
say that's a really good question.
And it is. I think that in some ways it's already happening, but I think one of the areas where we are starting to see signs of change, but there could be so much more, is in the formal reporting, the annual report and account. You know, when I look at Unilever's document, it's as thick as a telephone directory. So much of it is compliance-based, and so little of it is actually communicating to investors what they need to know. And I think there is movement in that direction, and of course there are people in this room working very hard on that. But if the regulators could help us move in that direction, it would make a huge difference, I think.
Well, slightly off the topic of today, but I would be very strongly in favor of mandating either a price on carbon or a disclosure of carbon-based assets.
Yeah, I suppose my build on that is I think the role the regulation can play is by putting a true cost or a true price on scarce resources. You know, whether it's water or carbon. At the moment, you know, the way that we account for these costs in our own P&Ls does not reflect the true cost to either the economy or to society. And if through regulation they can effectively impose that cost upon businesses, then it's more likely to encourage the right type of behaviour from those businesses in saving those costs. All of that said, I don't think we can sit here today and rely on regulation to do that hard work for us. I think there's a lot of stuff that companies can do on the front foot proactively about pushing these principles without having to rely on regulation to solve the problem for us.
Thank you. I've got time for one more question. There's a gentleman here in the middle, so it's immediately behind Harry. Thank you.
Thank you very much. There's a lot of moral hazard in responding to this because I am a regulator. I chair the Malaysian Securities Commission, and I'm also the vice chairman of the board of the International Organization of Securities Commissions. Let me say first of all that one of the challenges from the regulatory perspective is to be able to elevate the conversation a lot more deeply than is currently taking place. And I must say that that's one of the things that I've often said in the discussion on the Integrated Council, that we need to get this conversation deep and a lot more there. Whilst I do not prefer that there needs to be a regulatory solution to this, but certainly the awareness has to go up. But the comment I wanted to make and get some reactions from the panel on was that I think partly in the conversations that I have with investment managers, a lot of them react by saying, look, we are there to maximize returns for our contributors. And in many ways, the discussions that I see happening in this space is not dissimilar to a conversation, say, that would have happened 15 years ago on corporate governance. And people were yet to be persuaded, maybe 15 years ago, and I look at, say, the perspective in Asia, for example, on the real value of corporate governance. Today, nobody questions that. Everybody realizes that the importance of good governance in contributing to better returns and in the value to the contributors is a given. I think we need to see a lot more demonstrative effect of the sustainability agenda in terms of long-term returns. And I'm not sure whether panelists can share with me what effort has been put down there, because ultimately to change that conversation, you must show that this does the right thing in terms of return to the contributors. Thank you very much.
So that's a fantastic last question. I'd like to ask each of the panelists to respond to it and perhaps make one, and it may be part of the response, one final comment before we wrap up this session. So John, are you happy to
Sure.
start
Yeah.
on this one? Thank you.
I think if fund managers, as you say, focus on maximising returns, then it has to be the onus of companies to demonstrate to those fund managers why adopting sustainable business models does just that, maximise returns. And actually, I know there's a lot of talk about long-term plans, but when we look at our business, and in particular, for example, when we look at the investments that we make in saving energy costs, I mean, this figure always blows me away in terms of its scale. Is our business consumes just below 1% of the UK's electricity, which I always find staggering. And yet, so we invest hugely in saving energy costs. The payback on the investments that we make in saving those energy costs are actually our most accretive, fastest paying back investments of all the investment we make, typically a 3 to 4 year cash payback. So I think that's a great example of being able to demonstrate that by embracing these principles, it does just that. It does absolutely maximise shareholder returns. And I guess my one sort of closing comment, and perhaps I've said this comment already, but reiterating it again, is I do think the onus has to be on companies in getting these messages across. I think we need to keep talking to investors, keep demonstrating in our responses to the questions why we believe that having sustainable business models is a great thing for them in terms of their long-term returns.
Thank you, Roger.
And from my point of view, there have been times in my career, if I look back and I think of how we ran parts of our business where we did try and deliver short-term financial returns, and they were always that. They were always short-term. And we always then had to come back afterwards and realise that the only way to build long-term value is to think about the consumers, the customers, the communities, and if you get those right, then the shareholders will be rewarded. And it sounds a little bit like a flippant statement, but we've sort of learnt it the hard way. So, I take your question really as a challenge that we need to get better at communicating the value, not only from the things that are easy to value, like the energy examples that we've talked about, but also the harder things, for example, in the areas of social, and in the area of water, by the way, which is far harder to get really kind of good paybacks in current approaches. And I think the onus indeed lies on companies to get better at doing that so that we can make the case to investors.
I think two comments I would make would be, one, from the very beginning, we have integrated sustainability into our investment process because we think it will make us better investors. Not for sure, but we think it will make us better investors, allow us to judge the quality of business and quality of management more effectively. Now, I've, over the years, realized that as soon as a fund manager tells you how smart they are, that's exactly the point that their performance goes down. So I'm not suggesting that I'm going to talk about performance, except to say that after 10 years, I can assure you that sustainability does add value, and in fact, it is not a trade-off.
That's a great note to finish on. So thank you very much to our panelists.